How to invest for beginners. 3 simple rules. When people hear the word investing, it often feels like something complicated, risky, or reserved only for Wall Street professionals. Many beginners imagine endless financial charts, complicated mathematics, and the possibility of losing everything overnight. But in reality, investing is not some secret knowledge. It is a skill that anyone can learn. And the earlier you start, the better your future financial situation will be. Today, I want to share with you 3 simple rules that can guide beginners in the world of investing. These rules will not turn you into a millionaire overnight, but they will give you a strong foundation for building long-term wealth. Rule number 1. Start early and be consistent. The first and most powerful rule of investing is simple. Time is your greatest ally. When you start investing, even with small amounts, your money begins to work for you. Thanks to a concept called compound interest, your investments grow not only on the money you put in, but also on the profits that your investments generate. In other words, your money starts making money. Here's a simple example. Imagine you invest just $100 every month. That doesn't sound like much, right? It's the cost of a few dinners out. If you do this consistently for 30 years, and your investments grow at an average rate of 8% per year, you will end up with over $135,000. But here's the magic. You personally invested only $36,000. The rest, almost $100,000, comes from growth and compounding. That's why starting early is so important. Even small, regular investments can snowball into significant wealth. Another key part of this rule is consistency. Many beginners make the mistake of investing only when they feel like it, or when the market looks exciting. But markets go up and down, and no one can perfectly predict what will happen tomorrow. By investing regularly, every month or every paycheck, you avoid trying to time the market and instead benefit from steady growth over time. In simple words, start today, start small, but stay consistent. Rule number 2. Diversify and don't put all your eggs in one basket. The second rule of investing is about safety and stability. You've probably heard the saying, don't put all your eggs in one basket. That's exactly what diversification is about. It means spreading your money across different types of investments so that if one performs badly, the others can balance it out. Let's look at an example. Imagine you invest all your savings into one company, say your favorite tech brand. If that company does well, your investment could grow quickly. But what if something unexpected happens, like a bad earnings report, new competition, or even a scandal? Suddenly, your investment could drop by 30%, 50%, or even more. Now, imagine instead that you spread your money across several large companies, different industries like technology, healthcare, finance, and energy, and maybe even different countries. If one company or sector has a bad year, the others can protect you from losing everything. That's the power of diversification. For beginners, the easiest way to diversify is through index funds or ETFs. These are investment products that allow you to buy a small piece of hundreds or even thousands of companies at once. For example, an S&P 500 index fund gives you exposure to the 500 largest companies in the US. With just one purchase, you instantly own a part of Apple, Microsoft, Amazon, and hundreds of others. This way, you don't have to spend time choosing individual stocks or worrying about picking the right one. Diversification protects you from major risks while still giving you steady growth over time. So remember this rule. Never bet everything on one company, one industry, or one trend. Spread your investments wisely. Rule number 3. Think long-term and control your emotions. The third rule might be the most difficult for beginners because it's about psychology. When you start investing, you'll notice that the market moves every day, sometimes up, sometimes down. In one week, your portfolio might grow by 5%. The next week, it might fall by 7%. These ups and downs are normal, but for beginners, they often create panic or overconfidence. Here's what usually happens. When the market goes up, beginners feel excited and invest more money without thinking. When the market goes down, beginners feel scared and sell their investments at a loss. This emotional cycle, buying high when things feel good and selling low when things feel bad, is the exact opposite of what successful investors do. The truth is that investing is a long-term journey, not a short-term game. If you look at the stock market on a day-to-day basis, it seems unpredictable and chaotic. But if you zoom out and look at decades of data, the overall trend is upward. Despite wars, recessions, pandemics, and crises, markets have historically grown over time. That's why patience and discipline are so important. Successful investors don't panic during downturns. They stay calm, continue investing regularly, and trust the process. One simple way to control emotions is to set clear goals before you invest. Ask yourself, am I investing for retirement? For a house? For long-term wealth for my family? When you have a clear purpose, it's easier to stay focused and avoid emotional decisions. So the third rule is be patient, stay disciplined, and think long-term. Putting it all together, let's recap the 3 rules. Start early and be consistent. Even small, regular investments grow massively over time thanks to compounding. Diversify your investments. Don't put everything on one company or trend. Spread your risk for safety and growth. Think long-term and control your emotions. The market moves up and down, but patience and discipline lead to success. These 3 rules may sound simple, but they are the foundation of successful investing. You don't need to be a financial expert to follow them. You don't need to spend hours studying stock charts. You just need the discipline to start, the wisdom to diversify, and the patience to stay the course. Final thoughts. Investing is not about getting rich overnight. It's about building wealth step by step, year by year. It's about giving your future self more freedom, more opportunities, and less financial stress. If you are a complete beginner, the most important action you can take is to start now. Don't wait for the perfect moment or the right conditions. There will always be uncertainty. The best time to start was yesterday. The second best time is today. Remember, the world of investing may seem intimidating, but by following these 3 simple rules, you can take control of your financial future. So take that first step. Your future self will thank you.